Hi, I'm Pattu from Freefincal, and let's discuss some of the questions asked by viewers over the past few days. In this video, I'll try to keep this video about 15-20 minutes in duration so it doesn't get too long. So, can I consider ICICI Multicap as only fund in my portfolio among multi-cap segment instead of ABSL equity fund? Well, um, I don't offhand remember the performance of ICICI Multicap, and I cannot just like that say I you can have one fund one equity fund portfolio, and that could be a multi-cap fund. And if you're comfortable with ICICI multi-cap performance, go ahead. Instead of, I don't know why do you want to ask that? I mean, if you are comfortable with your fund, go ahead, have that as the only fund. Dipanjan says, my portfolio has 4 equity funds. Out of these 4, I want one fund to take high risk and generate higher return in the long term. Do not assume higher risk is higher return. That's an investor mistake I talked about. Okay. I have 2 multi-cap and 1 large and mid-cap. Should the 4th fund be mid or small cap or a focused fund? See, focused fund means if you can find, okay, let us assume, I'm not going to comment on whether having 4 funds is a good strategy or not, because that's not what you asked. Find out if you can, see, focused fund means, focused means it has got 30 stocks. Those 30 stocks can be anywhere. It can be a focused large cap fund. It can be a focused multi-cap fund, focused large and mid cap, or focused mid cap. If you can find a focused mid cap, go ahead and try it. My suggestion would be to have a focus on a mid small capish kind of fund, where it is a mid cap fund. It doesn't have a lot of large caps because you already have large caps in your portfolio. It takes bulk of the portfolio should be mid cap. It takes a little bit of small cap exposure. Choose that kind of fund if that's what you want. SBI Magnum Constant Maturity Fund Debt. Can you please review this? SBI constant maturity, see, all constant maturity funds, that is, it will hold 10-year bonds primarily, so that its average duration will be very close to 10 years. The problem is all constant maturity funds are very new. They're just 1 year old. So because it's a newly formed category, so there's nothing for me to review in terms of performance. Look at the scheme document. Look at where it invests in addition to that 10-year bonds, because 10-year bonds is only 80% of the portfolio. Look at where it will invest in that 20%, and if you are comfortable, if it holds cash or very safe low duration bonds, you can go ahead and use it. But you should know how to use it. I have a guide for gilt funds. Did I make a video on that? I don't remember now. You can check out my post on gilt funds. Okay, let's see this. A retiree with cash wishes to generate tax-free income after making the tax-free, maxing the tax-free amount for retiree FD, say 50 lakh. I saw your post on generating tax-free income from arbitrage. Can we do an mix of arbitrage and short-term bond funds? Like, for example, withdraw year 1, year 2 from arbitrage corpus, year 3 from debt corpus, year 4 from, and so on. This essentially prolongs the arbitrage corpus as well as save tax from, if such a thing was, kindly advise if such a thing was possible and what percentage of allocation. See, I cannot be giving you advice on what percentage the retiree should be investing, because I have no idea how much money the retiree has, what are the needs of the retiree. In general, yes, you can generate income, tax-free income from arbitrage funds, because you can withdraw up to the 1 lakh capital gains amount. And what this person is saying is, I will withdraw 1 year, then wait for 1 or 2 years, then I will withdraw one more, because there will be some money to withdraw, and that's significant money to withdraw. I think that's what's being said. In general, that's a good idea, but whether it is applicable, whether it is suitable to that retiree, I don't know. That is something that I cannot answer. It is not because I don't know to answer, it is because I don't want to answer, because it is irresponsible, and we should not be doing this over social media. Please get help from a SEBI registered fee-only financial advisor. If you go to freefincal.com, right in the top menu, you will have the list of financial advisors. Click on that, fee-only financial advisors. Click on that, choose one of them and work with them. I'm currently investing 25,000 in mid caps and large caps. Is it a good idea to invest 5k in this fund? You are already investing in mid caps and large caps. Why do you want focused India? No, there's no need for it. And apply tactical approach following the TMM average for only this fund. Why? See, you are investing 25,000 there. This is please. This is an example of small exposure problems. Please, your bulk of your investment is in those funds. Why do you want to apply tactical asset allocation only for this fund? What is the use? If you want to reduce risk in your portfolio, do it for the whole portfolio. Otherwise, there's no point. It will just give you some psychological advantage, maybe if it works. If it works, I don't know. Don't waste your time. Don't invest in this fund. Don't apply tactical asset allocation only to a small part of it. Okay, this is about the weight loss. Okay, fine. Does sticking to active funds of top 10 AMCs improve the probability of beating the index? No, I don't. Like I said, I don't see why it should be. Why it should. Thank you. Fine. Okay, let's question. Downside protection, is it fund level or overall portfolio level? Overall portfolio level, if you want downside protection, you should do tactical asset allocation. So it should be for people who do not want worry, who don't want to do tactical because they're worried or because of taxes and so on. It should be fund level. If each of your fund has got downside protection, then automatically the equity portfolio will have downside protection. Entire portfolio, equity plus debt, for that downside protection, you need to have some kind of tactical asset allocation. See, the problem is most of us are not worried about portfolio level risk, portfolio level returns. We are just looking at piecemeal. This fund made that much. This fund is in green. That fund is in red. We have to graduate beyond all that. Combination 1, aggressive hybrid plus debt fund. Combination 2, pure index funds for debt fund. My understanding, both the above combos, downside protection is achieved. Pure index funds from debt funds will have some downside protection. Pure index funds will not give you the downside protection. Why not pure index funds? At least you can save you can save some expenses in the case of hybrid funds. There is in the combination 2, the equity part does not have any downside protection. So how will it? See, the reason why I keep saying aggressive hybrid fund is because you are guaranteed of downside protection, because at the very least, even if you have an idiot as a fund manager, every month he will rebalance between equity and fixed income, and that will give you guaranteed downside protection to that much extent. In addition, his or her stock picking skills will decide further. That you can look at the fund history and talk about. That is the reason why I prefer aggressive hybrid funds plus fixed income. So combination 1 will naturally have downside protection. For combination 2, you have to do the downside protection by tactical asset allocation. Let me try reading this. By तुझे हिंदी आती है तो हिंदी में ही एक्सप्लेन कर दिया कर बेहतर रहेगा व्यूज के लिए बेहतर रहेगा. हिंदी में जानता हूँ, समझ सकता हूँ, थोड़ा थोड़ा पूछ सकता हूँ, लेकिन फ्लुएंट नहीं हूँ. तो मैं हिंदी यूट्यूब चैनल्स देख रहा हूँ पूछने के लिए. काफ़ी शीघ्र ही एक हिंदी वीडियो रिलीज करूँगा. थैंक यू. When to wear hat of analyst and when to be investor? More knowledge you have, more difficult it becomes. Yes, sir. I made this video a long time ago. There's no question there. Yes. Few questions. Let's see. Why to invest in hybrid if you have 60-40 debt asset allocation? Hybrid also has somewhat same as asset allocation. Even asset allocation provides downside risk, right? That's a very good question. I have a very specific video on this. Go to my channel. If you go to the Freefincal, see below this video, you will see that Freefincal name. Just click on that. It will take you to the channel main page, and there you will see on the top. You will see the magnifying glass. Click on that. Search for hybrid funds or aggressive hybrid funds. I have a video exactly why, because the risk associated, in a nutshell, the associated risk of equity funds, let's say, is at that level, it's only aggressive hybrid is only little bit lower. It's only a small drop, so it's not significant. That's the reason why I think of them as pure equity funds. What is the best way to analyze a fund's return? Is it rolling return, annual return, trailing return, or anything I do not know of? Rolling return gives you consistency of performance. Annual return gives you a quick measure of what your fund, your holding has done over the last year. Trailing return similarly. So it's a before I buy a fund, I will look at the rolling return. After I buy a fund, I will look at rolling return from the date of investment. But it is easier for me to quickly look at annual returns, trailing returns, and so on. If there is no compounding in equity, as it is volatile and gains are not linear, as explained in one of the videos, why not one should take out the unrealized gain and keep it in FD behind, leaving the original sum at regular intervals. Ha 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 ha. This way, when at least when equity falls, loss will be less. Nice. See, the problem is, this is why I keep saying. So what this person is saying is that you have some gains, pull it out. You have some gains, pull it out. First of all, in a mutual fund investment or stock investment, there is no such thing as invested amount gain, because it's based on you are buying at current price, you are selling at current price. There is no delineation between this is my investment amount, that is my gain. No, because it is just it is psychological what you think as a gain, because units are it's first in first out in when you redeem units. Second of all, if you keep on removing the gains, the corpus will not grow. Your returns will not be affected. No matter how many redemptions you make, your XIRR will always be the same. It will not be affected. But it will be a case of operation successful, patient died, because your returns will not be affected. But the final corpus that's there in the equity will be less, because if you keep on taking out money in the name of gain, in the name of profit booking. Finally, what do you want? Corpus, right? You want money. You don't want returns. You want enough corpus. If you want enough corpus, you need to keep it in there, and only rebalance at least once a year, no more than that, at least for some time. So don't. If you try to be smart in an equity investment, there will always be problems. Don't try to do that. ICICI Nifty Next 50 fund NAV is higher compared to UTI Nifty Next fund NAV. It doesn't matter. NAV does not matter. NAV is just a number. I can release a fund with 25,000 as NAV tomorrow. NAV does not matter. Look at the rate at which the NAV is changing. Look at that for both these funds for a given time period. Then compare the return. Then decide. I have a video coming up. I'm doing a very detailed analysis on mutual fund tracking errors. I'm creating my own idea, my own definition of a tracking error. It will take me some time to run the calculations. I'll publish it sometime next week, maybe. Central government employee, please watch video on new changes in NPS about choosing life cycles. Please do not make any changes to your existing, if you're a central government employee or state government employee, please do not, I am also one, I also have government NPS. Do not make changes to your NPS asset allocation. Keep that as fixed income. You invest in equity elsewhere. That's what I have essentially said. Okay, that's not a question. Thank you. This video has some positive comments. My goal is 15 years away, and I've started accumulation. How many? 15 minutes are up. I'll just finish. I think we'll have to do another Q&A part 2 probably tomorrow. We'll do that because I don't want to make it more than 15 minutes, 20 minutes. If my goal is, because already this is recording in HD, so it will be like 6 GB, 7 GB file. If my goal is 15 years away and I've just started accumulation for that purpose, can I have overall equity portfolio, all equity portfolio, that is 100% equity for 2-3 years, and then start adding debt, gradually reducing the risk? In principle, yes. But you are only going to have it for 2-3 years. Might as well start with 60-70%. It will not make a big difference. So, oops. Okay. Whoa. Okay. Thank you. Thank you. Yes. Another mistake, instead of investing for tax saving alone. Yes, yes. I have a question relating to point 4. My parents, what is point 4 in that video? I don't remember. My parents are in their 60s and have a significant corpus invested in equities. Given the current political scenario, they are of opinion that from now on market is going to rise only. that's that's the point. Okay. Oh my God. Significant. They are. Please do not do that. They are of opinion. You need to have good. Yes, yes. Invest for a long term. I have doubts about this strategy. There no guarantee the markets, given their age. Yes, you are right. They should not have more than 50% equity. May given. Yeah, I don't know their corpus, but 50% equity. Unless that 50% is a large amount in fixed income, it's not a good idea, and they have some pension or something like that. Please be careful. No, they should not be. Whatever the scenario, whatever the market outlook, whatever happens, whichever government comes, if you are of a certain age, you should, once you are retired and you are senior citizens, reduce equity as much as possible. Don't try to get returns at the later stage and lose it all. That's very, very dangerous. Right. Thanks in advance for Q&A. I have queries on rebalancing, reduce risk. I will, okay, let this be the last question. Then we will do the remaining questions in tomorrow's video. So let me just make this. When should one rebalance? Once a year rebalancing is okay? Yes, I think it's okay. Good enough, more than good enough. Should one also add another rebalancing trigger based on allocation band like 5%? Yeah, 5% is called trigger rebalancing. You can have trigger rebalancing and not do the systematic yearly rebalancing. That is also fine, but you may need to do yearly rebalancing as you go near the goal. And in addition to all this, you should also reduce the equity allocation stepwise. So, when is rebalancing risky? Assuming a case when I have a stock bond 60-40 allocation, stocks drop and they're in a prolonged bear market, based on my yearly rebalancing trigger, I will attempt rebalancing. I will be selling bonds and buying stocks to get back to 60%. As stocks are falling, I will be buying more and more stocks by selling out. I will be continuously feeding the bear and progressively. When should I stop? Yeah, look at your goals. You should not blindly do it. You should. That is the reason why I say you will. Why are you having 60-40 all those years? No, you start with 60% equity. After 3-4 years, bring it down to 40%. After 3-4 years, bring it down to 30%, 20%, and so on. I'm talking about, let's say, a 10 to 15 year goal. I have a video on this. If you use my robot-based template, it will give you those steps. Use a stepwise strategy. So you will not be continuously feeding the bear market at 60% level. You will be feeding it at a lower level. Even otherwise, you should not only look at the asset allocation. You should look at the target corpus, and your goal should be to gradually move your money into fixed income assets. That's why I told you, for my son, he's 9 years old, but I'm ready to send him to UG now. So that is the goal. You should not blindly do rebalancing. During the initial years of investing, you can do rebalancing annually, or you can do trigger rebalancing. When the asset allocation deviates by 5%, you trigger the rebalance. After, let's say, 5 years or so, you have to look at your corpus, do goal-based risk management. Then you can slowly build up the fixed income allocation, and therefore the rebalancing into equity will become much less. So there's no need to worry about it. It's a very good question. I hope I've answered that. It can work both. Yes, it can work both. That is the reason why I said yes. I hope I've answered that. That is the reason why I said you should always keep your goals in mind. You are not going to look at returns. You're not going to eat returns. You're not going to buy with returns. You're not going to buy with asset allocation. Money in safe assets. At the end of the day, that is your real asset. So that's 20 minutes. I'll stop here. We'll take the rest of the questions in tomorrow's video. Thank you so much for your patience. Bye-bye.